Many are wondering if now is the best time to invest their money in stocks and build wealth. With interest rates near historic lows, stocks have been soaring higher on the stock market. Despite this optimism, there's still a looming fear of an impending recession that could cut these stocks in half. So, what would one of the top investors in the world, Warren Buffett, do now? Is this really the best time to build your wealth, or should you be leery of stocks at this critical juncture? Make sure to watch until the end, where we'll reveal how mega companies stay afloat even through unprecedented recessions. For the past 10 to 15 years, the financial markets have been on an unprecedented growth trajectory. After hitting rock bottom during the global financial crisis, the stock market made a remarkable comeback over the next decade, earning one of its best performances in nearly 140 years. With money being cheaper and easier to access than ever before due to interest rates at only 2.5% in 2019, businesses could expand, investors could make more money, and valuations got an amazing boost. There was an air of expectation that whatever you bought would double in no time. Unfortunately, 2020's pandemic put a halt to this historic bullish run, as reality burst what looked like a surefire bubble. Investors were losing confidence and yanking their money out of the stock market, leaving the world of investments on its knees. Panic had set in and businesses were closing up shop. As if this recession couldn't get any darker, central banks across the world started printing money to help governments cover some pandemic-related costs. The US Federal Reserve printed an astronomical amount of money that quickly made its way into the economy through stimulus checks and bailout packages. Despite the influx of free money, US citizens are still struggling to make ends meet. The high inflation rate that reached a 40-year peak in June puts everyday items out of reach and continues to chip away at their wallets. It's not just rising prices that plague the nation. There's a prolonged economic crisis looming overhead.
On a year-over-year basis, when you're looking at where inflation is, we thought we could say it peaked last month. It did not. 8.6% for the month of May. That matches the all-time high in this cycle. And the core rate up 6%.
The U.S. Federal Reserve's decision to raise interest rates had dire consequences. Businesses and citizens found it harder to access money. The economy halted and panic spread across financial markets. Cryptocurrencies plummeted as well-known corporations began to struggle. The real estate sector took a hit, and investors started selling off their shares, fearing that the world was nearing an apocalypse of a recession. What is the best timing for investors to enter a market, though? When everything is discounted, or when the markets have already reached their peak? So, you want to get rich? Crashes are like a gold rush. They don't happen every day. But is this the right opportunity? Should you take advantage of it and build your wealth? We'll explore if this is the right time to strike it rich, and if so, how to make the most of it.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all.
Investing isn't just about numbers. There's an emotional component too. People often succumb to fear and uncertainty when markets become volatile and choose to exit at the wrong time, buying high and selling low. But those who stick it out are often rewarded with success if they can be brave enough to buy when prices are down. Can you handle the risk? It may be a bumpy ride, but there are plenty of rewards if you know how to play the game. However, experts like the venerable Warren Buffett, Charlie Munger, Manish Pabrai, Guy Spear, Phil Town, and many more contend that the ideal moment to invest is when the market is severely down. It's like that sinking feeling when you realize you've made the wrong move in a board game, except this time it's your hard-earned money on the line. Many investors lack a clear investment plan and buy high, only to sell off in fear once things turn sour. This may be an understandable reaction, but it's also a terrible strategy. Instead, why not seize the opportunity and make hay while the sun shines? It takes courage, but if you can master it, the rewards just might be worth it.
We're a net buyer of stocks over time, and who wouldn't rather buy it, at a lower price at a higher price? People are really strange on that. I mean, because most of your listeners are savers, and that means they'll be net buyers, and they should want the stock market to go down. They should want to buy at a lower price, but they have that feeling that they just feel better when stocks are going up.
Let's examine the historical bull and bear markets in the US since 1926. Bull markets are blue, whereas bear markets are orange. You might see that recessions are outbarred. It is clear that the US has seen 11 bear markets and 15 recessions since 1926. The total number of bear markets would increase to 12 if the 2020 pandemic crash were included. In total, bull markets lasted for 75.4 years, while bear markets persisted for 14.7 years. However, it is a truth that if you had made investments during these tense times, you would have gotten good returns. For instance, profits following the Great Depression were approximately 265% over a period of 4.4 years. Then, as the trend continued, they made 43% in 1.8 years, 210% in 4.1 years, and almost 900% in 14.8 years. People who made investments during the biggest bear markets in recent memory had gains of 20 to 50% in just a year. Although there is no ideal market in which to invest, these trends demonstrate that these bear markets do present excellent chances. For instance, you would have earned 9% on your investments if you had made them at the top, right before the 2020 COVID outbreak. On the other hand, you would have profited 60% if you had invested at the market lows, which were a few weeks following the peak. This is how a difference-making entry point works. However, you must keep in mind that such significant decreases do not occur frequently. 75.4 years of bull market versus 14.7 years of bear market. So, it can be said that recessions are excellent times to invest. But how do you take use of this chance without squandering it? The first step is to stay current with market events so that you can anticipate when these possibilities may present themselves. Step 2 is to correctly implement your strategy, whether actively or passively, as soon as you notice a market downturn. We are all aware that there are a few different approaches to long-term investing. Either dollar cost averaging is used, or long-term value investment in the manner of Waren Buffett. Now, the majority of people use dollar cost averaging. For those who are unaware of what dollar cost averaging is, it is the process of diversifying your investment portfolio across the stock market. They choose the market tracking investment, and then investors invest the same amount into the market tracking investment fund on a regular basis. An example of this would be investing in index funds like the S&P 500 Index Fund, which is also the largest index fund in the world. It may be $2,000 twice a year or something similar, with your money being distributed around the entire market. This approach was created to provide the market with a long-term reward, which for the S&P 500 is typically 10% yearly. With this method, you don't appear to be timing the market or taking advantage of a market downturn, but you actually are. For instance, on October 9, 2007, $2,000 purchased you 12.78 shares of SPY. A year later, when the market was beginning to decline, $2,000 bought you 20.5 shares. This is easy. When stock prices are lower, you buy more, and when they are higher, less. This is quite normal. For passive investors, taking advantage of the opportunity is best done in this fashion. Aside from this, investors embrace Warren Buffett's strategy of building individual companies because they want to have more control over their portfolios. They are aware that they have a competitive advantage, as well as competent management teams and better price margins. However, we won't be discussing this tactic. We'll discover how proactive investors make sure they don't commit any errors when making investments in a volatile market. When the going gets tough, businesses need to know how to keep their heads above water. We know what's causing the rough patch: inflation and increasing interest rates. But it's up to each company to ride out the waves. Price power is key. Those businesses who can adjust their price points, such as Coke, will remain successful in spite of higher costs. Whereas other companies might need to dial back prices due to reduced consumer spending. Add in expensive debt thanks to rising interest rates, and it's a trifecta of financial struggles. Surviving this storm isn't easy, but those with the best business strategies will come out ahead. Therefore, you must guarantee that you have less debt if you want your organization to function successfully during these times. Make sure to subscribe to the channel if you're enjoying this video and you want to see more like this one. When it comes to investing, the name of the game is to be prepared for a tough economy. Companies with more cash than debt and a debt-to-equity ratio of 0.5, like Google, are extremely attractive because they can make more from interest payments than they pay out themselves. Plus, companies like Meta that don't use any debt at all are especially solid investments. No money owed guarantees you won't go under. But those aren't the only factors to consider. Active investors should also examine the business model. If the business you have your eye on operates in an industry that's known for standing tall through economic downturns, like many grocery stores, then you've struck gold. No matter what type of investor you are, active or passive, having a long-term outlook, staying strong, and watching our videos can help ensure success in uncertain times.